Welcome to Onchain Capital, your front row seats to the future of finance. From Web3 innovation to digital asset policies and the power shift between the East and West, we are going to talk all about that today with Jerald from the CEO of Link. Jerald, thank you so much for coming on the show.
Amazing, Sean. It's great to be here. Thanks for having me today.
So it's great to see you in Hong Kong. I know you've really lived in many different major cities around the world. You live in New York now. You were in Dubai for a bit. Maybe tell us a little bit about your journey and also specifically what you're doing now at Link and what led you to Link.
Yeah, absolutely. I think the journey really kind of begins, and we'll fast forward through all the traditional stuff, right? Well, the fun stuff that you, of course, want to see, which is really all the crypto stuff. I think the journey really begins somewhere in 2017 when we began this quest to take traditional structures and find a digital wrapper that we could put around them. And the thesis originally, when we started thinking about these things, which really ended up becoming the RWA craze that's out there right now, was how is it that you could take a structure that's commonly known and acknowledged throughout traditional finance, or a wrapper, if you will, right? And we gravitated towards a 40-act wrapper. And you have a couple of different options: mutual funds, closed-end interval funds, open-end funds, etc. But the thought was if we could take a treasury and we could wrap it, we could make a tokenized version, of course, that was highly regulated, right? We're not skirting regulation at that time. And this is early now. This is 2017, 2018.
Well, that is early. I mean, what you're talking about now, we see it in the market already by different large players, small players, native players, and whatnot. 2017 is very early.
It's very early. And you can imagine the conversations we had in 2018 with the SEC, bringing them up to speed on what our actions and our plans were, which were to take a treasury fund. And originally we had thought about treasuries, right? Which I think is the holy grail that everybody has been picking up. But it comes with some challenges and a lot of government, permissions and, a lot of hair, if you will, in trying to do that. Yeah. So the thought was, let's take a fund, let's go ahead and put a wrapper around it, and then let's change the delivery mechanism. So let's not change the fundamentals. Let's not change, kind of the responsibilities that one would have it as an advisor, that you have as under a registered RIA, of course. But let's go ahead and think about how we could change that delivery mechanism and take like a paper share that doesn't even really exist anymore, right? That hangs out either at a broker dealer or DTCC or somewhere where you don't know that you actually have authenticity of it. So take it, create a digital asset security of it, and not skirting regulation, put it on a public blockchain and enable AML KYC users to send shares of that fund as a payment obligation to settle something that you'd like to anyone. That was AML KYC.
So back in 2017, I still remember, before this current administration, the hurdles and the challenges that you had to get through with these traditional financial products and then trying to put them onto the digital ledger, right? So that must have been a lot of groundwork, a lot of research, a lot of negotiations you had to do with the regulators.
Yeah.
And was that primarily in the US that you had to do that, or you had to do that in other markets that you were looking into as well?
So we were starting in a good spot because we were already, kind of complicit, and we were actually overseen by, the regulator as an RIA. But those conversations themselves, which I think will shock many people, weren't, there was no hard no. There wasn't a door being slammed in our face.
Okay.
We were met with interest, right? And curiosity, right? And the conversation started with things that, would be very different right now, which is, what blockchain are you going to be using?
Right.
Rewind to what the time frame where we are.
Of course.
The answer is, how does Ethereum work?
Yes.
How does that blockchain, what are the protections? What are the risk management precautions one would have? Investor, sentiment. How is it your investor's not going to get hurt? Mm-hmm. And I think that those are the discussions that we were having with the regulator, who were quite open to the idea. But I think, like you said, there needs to be a really mindful back and forth. Yeah. There was a lot of research-based information we were presenting to them.
When you talk about these tokenized products, even in those early days, we had different settlement networks that were really built to facilitate kind of that traditional banking rails, digital asset rails. I remember there was something called Signet, right? That was really quite innovative when you look at the architecture, what it's looking to solve. Obviously, what had to go through, a number of different hurdles and since then. But the settlement aspect between these newer tokenized tokenized products that are based on traditional financial instruments, and then living on public blockchain, that's got to be something that's quite interesting. I believe that's what Link is really built to do, is to solve that and make that more efficient. So tell us more about Link.
That's exactly right. And, Sean, when I think about, Signature Bank, and I think about what they did with Signet, it was one of the most important pieces of infrastructure in this industry that unfortunately was taken away.
Right.
You think about the evolution of these markets and all the challenges that we had encountered. I would say that the decommissioning of Signet, when the bank itself was shut down, set the industry back in a major way.
Yes.
I became infatuated with Signature Bank and Signet, and the team over there built something that was just amazing. If created a network, it brought a community of 2,000 users together. It allowed for them to transfer outside of banking hours, although it was being done within a bank. The benefits and the connectivity that was created in a private permission blockchain was exceptional. And what we're building now has so much of the fingerprints of that business on it, and the team that brought that to market just did an amazing job with this. But then it wasn't. So what do you do?
Yeah.
Right. And, it was somewhat logical that we began working with a company called Tacit, who was the creator of the technology that underpinned Signet.
I see. That's where the connection comes in. I see. Interesting.
Yeah, and they're one of they're one of three core partners that actually comprise the Link networking what we've created there.
Okay.
But the infatuation continued not just in thesis or theory, but we were working closely at ARCA with the Signature Bank team, and the SEC when you're bringing back kind of the SEC and. I was stating that I felt like they were, kind of not an obstructionist regulatory body for us. One of the last things that we did before Signature Bank went away was that we worked with Signature Bank, and in concert with them, the SEC allowed for clients to subscribe to a 40 Act fund via Signature Bank Signet. So via, kind of a tokenized cash deposit.
Right.
And you think about how unbelievable that is, at that time, because, for, the 40 or 60 years preceding that, under the 40 Act, even more. Clients were only allowed to go ahead and subscribe to a fund via US dollar, via ACH and wire.
Right.
And they enabled for us to do so via tokenized deposit. So, intellectually, we probably could spend an entire show on this topic, but intellectually, it's fascinating to think that the regulator themselves was that forward thinking and understood the properties of what a tokenized deposit would be. So then we get to the point where Signature Bank was no more.
Yeah.
Industry was in shambles. Risk was being introduced instead of being mitigated, which is a really, really, really terrible situation to be in because obviously financial instruments are intended to do that. And the industry had no real way of interacting with each other. And then there was Tacit that had the technology that, was loved by so many different market participants, banking grade, institutional strength, had over $3 trillion worth of transactions on the network, 2,000 users, like I said a second ago. And Signature Bank had probably $27 billion on platform when it was decommissioned. So the thesis was that if we could take that technology in partnership with Tacit, take it out of the banking network, and then put it in a broker-dealer facilitated environment, it would create a ton of different efficiencies for the users, but also have some really, really strong benefits.
So tell us where you are now, right? The world obviously have changed quite a bit in the world of digital assets. Let's not talk about the world in general. That's yet another show. So in the world of digital assets, not only have the U.S. really progressed very aggressively from an institutional adoption perspective, right? You see products that are getting rolled out. We've had conversations with Franklin Templeton, UBS have also put their tokenized money market funds products that they're releasing. So you're starting to see a lot of that in the market. And more importantly, I think you're starting to see that in other parts of the world as well, right? So are you building links to be very US focused, or there must be a reason why you're here as well? So tell us more about how you're thinking about interacting with other financial institutions and how you're settling these different capabilities through the network.
Yeah, it's absolutely right. I mean, we're here at Consensus in Hong Kong because the market we're building, although we're domiciled in the U.S., is a global marketplace. Right. And when you think back to the genesis of the business, we aligned ourselves with some of the largest names in the space. Only a couple which are actually located in the U.S. So the outside of ARCA, Tacit, and T0, when we first started thinking about how we could do this and started testing thesis amongst some of the bigger participants, P2C2, FalconX, Galaxy, Wintermute, Crypto.com, and Fireblock all signed on immediately. I see. And they immediately said, look, this makes a lot of sense. We need to replace that infrastructure that is gone. How can we help? And we began going through how we were going to structure things. We started talking about, interest generation, right? And figuring out how we could actually deliver yield back to
In
clients.
transit or in custody?
So it's actually in transit, and there's a patent, believe it or not, that that's filed called yield in transit. You know, kind of the way that a market maker might actually work or transact, you know, and how they manage their positions. They're concentrating in and out of positions. They're sending funds to exchanges as an on-ramp on our platform. They're sending peer-to-peer transactions to settle obligations they have with their counterparts. They're sending funds to other third parties out there that'll mint stable tokens for them.
Right.
So the name of the game here really is to go ahead and find capital efficiencies with the deposits you have on our platform through Link. So what you end up seeing now is clients are moving this back and forth. We take all the positions they have, we throw them into an algorithm. At the end of the day, around 6 o'clock, it spits out proportionally how long you held the position, what the dollar value was that you had, and then we send on the Avalanche blockchain a payment to the broker dealer that's redistributed no later than 7 o'clock Eastern time that contains that interest.
I see. So you send it to the counterparties or you send it directly to the users?
It goes directly to the broker dealer.
Yes. And that
Is that on behalf of the client, sub-accounting down below, and then ultimately they go ahead and they reconcile that position on platform with the clients.
Wow, amazing. Okay. So this is really working through a lot of it's working through a lot of the monopoly that the traditional banking industry have been really dominating. And now we're using traditional financial products, tokenized form, in a settlement network, distributed between different broker dealers that are handling various different aspects of their clientele.
That's 100% right. And what we've seen is, warm reception from the market.
Yes.
So now fast forward to where we are a couple of months after we've launched it. We've got crypto.com that's fully connected, and clients have been sending funds directly on our platform to fund their trading accounts for collateral. We've got an interface with Fireblocks, whereby clients who are Fireblocks users can access our platform via their GUI. We're working on a project whereby we've got one of our core partners that's bringing their counterparties on platform, and we've got an off-chain netting engine that's allowing for efficiencies for once-a-day netting. We've got a couple announcements coming up whereby we're bolting our settlement solution also onto an exchange, whereby they'll allow for their clients to go ahead and settle once a day via our platform, as well as some work that we're doing with ECNs and others. So that's the exciting stuff that we're doing in this space. And I think that one of the places, Sean, that I'm even more excited, and even as we were talking earlier today about it, it's some of the work that we're starting to do in trade finance.
Yes.
Yeah. Right. And I think that use case to me is just so fascinating. And it's fascinating because, what we're doing now is we're taking a digital asset delivery mechanism and we're incorporating it into, again, similarly how we created the fund, traditional flows that exist already, and we're taking it outside of the digital space. So it's not a digital asset play. It's taking a digital asset, putting in a traditional use case, and allowing for users to go ahead and harness the things that you and I and others have been working on for a decade.
Think about the account receivable, account payables, right? All of these invoicing on massive trade flows that are happening. And the reason why you and I were talking about earlier about this was because obviously you're now in Asia. A lot of the trade flow has been shifting to the east, right? Yeah. So China is now the largest trading partner with most of the world, including the US, right? So if you think about it from that perspective, then the origination of where the funds are coming from, and also in retrospect, how you repatriate some of those capital back, that's exactly where a lot of these trade flows are coming in. So you can essentially take the same concepts that you're building on the trading side and actually map it into monetary flows.
100%. And you think about it too, the network that we have, it's operated through the broker dealer. Clients are AML, KYC. So it takes that consideration and concern out of there. There's obviously, kind of one or two, kinks with using, some of the stable tokens that are out there, potentially with, Provenance, who's touched it previously. Yeah. Is it a possibility that I'm touching something that can get frozen?
Right.
And there's one other, use case too that I think is so cool. And it doesn't have to be, we talk about global. Yes, we're a US-based company, but think about a overseas domiciled firm that has, let's say, 60 or 70 or 80 different subsidiaries located all around the world. And you think about the pain that exists right now, how it is, treasury management internally. How are you sending funds? You're sending wires a day that are expensive. You got Forex charges. One of the use cases we're building out right now is simply that. It's setting up 60 different accounts for one firm and allowing for, an operations or a treasury person simply push a couple of buttons, move their funds across. It basically is allowing for them to go ahead and have their own, bespoke treasury management solution.
Amazing. That's amazing. Okay. So let's zoom out a bit, right? So we've learned a lot about what you're building, the clientele that you're working with, the partners that you have, and then the problem, more important, the problem you're trying to solve. Let's zoom out a little bit, right?
Yeah.
Let's look at the entire industry. I mean, you're right in the middle of it. So we continue to hear that obviously the crypto native markets are continuing to innovate. Lots of decentralized capabilities that are continuing to build in. Lots more primitives that are being put onto the blockchains. And then you've got the institutions doing a variety of different new innovations or new layers on top of the existing infrastructure. So, looking out, right? Where do you see all of this is going? And the reason why I'm asking this is obviously innovation will continue to move forward, right? But you do have the regulatory side that are, in some cases, pushing it, in some cases, restricting it. And when you talk about regulation, it isn't just one country. It is many countries now. We talk about these global networks. That's right. Every country have their own geographical considerations, jurisdictional frameworks. So when it comes to now doing what you're doing, but in different markets, what are some of the things that your teams are focusing on, and what are your partners thinking about as well?
Yeah, I mean, the regulatory question is something that, kind of we've been talking about and thinking about for years, right? I mean, the cool thing about the business we created is that it's, there's no gray area, right? Right. This is a highly, kind of compliant, structure that's been, created based upon a patchwork of licenses that exists through the partners with a technology associated to it that's, kind of banking grade.
Yes.
Right. So for us, kind of not overstepping jurisdictional regulators' rules and guidance is critical important for us. What it ends up doing for us, it just costs a lot of money, right? We end up having to have local counsel on the ground or implementing use cases. There are questions regarding the permissibility. How does this work within VAR? How does this work within MiCA? And the challenge that it creates, Sean, and you kind of, touched on it, is that without a global harmonized framework, you're going to have to keep doing that. Now, I think that for years, if you ever went to a conference or talked to anybody, the answer was, what's going to be the rocket fuel for the industry, right? And the answer is clear guidance, clear regulation. Well, guess what, guys? We've got it now.
Yes.
Right. Yeah. Generally speaking, we're 85 or 90% of the way there.
That's right.
And I don't think that we're ever going to find ourselves in a state whereby there's going to be any sort of superheroes, council that's going to go ahead and say, this is how it's going to work, from jurisdiction to jurisdiction. Yes. Right now, the game is set. And the winners are the ones that are going to be able to go ahead and fob and weave, stay within the lanes that are existed, and give products to users that make sense for them.
Excellent. Jerald, I think we can be talking about this for a long time. We'll probably have to bring you back onto another show.
I love it.
And really talk about the evolution of where all of these are going, because this is happening in real time. This is no longer, a space where people are just experimenting on the sides, right? It is going on the main stage, and it's going all around the world, not only in the US, but in other parts of the market as well. So thank you again for coming on the show. I hope you enjoy the rest of your trip, and I look forward to see you again.
Hello, it's a pleasure. Thanks for having me.
Thank you.
Chips.
All right.